Most investors I talk to should skip the traditional 1031 exchange because nobody wants to be a landlord in retirement. Thankfully, there is an easier path to mitigate the tax hit when you sell investment real estate. This is especially true for apartment owners, as dealing with tenants and state regulators is not exactly for the faint of heart. A politician can cut the value of your property in half just with the stroke of a pen. And please, I beg you, do not invest into a crappy deal just to avoid the tax hit, because that's a great way to light $5 million on fire trying to save $1 million. And believe it or not, that happens all the time. Because if you rush into a bad deal, the tax bill is always going to be cheaper than the big mistake. The entire point of tax strategy is to invest in great assets first. That's the best way to save money. It's not to just defer the taxes, it's about avoiding horrible deals first and then treat the taxes as a bonus. Because if the deal goes south and the keys go back to the bank, you still have a low basis to deal with. In other words, that nightmare scenario is when an unlucky investor has to pay phantom taxes on a foreclosed deal. That's not very good, right? So thankfully, there are other viable options besides the traditional 1031, and we're going to cover those today. We're going to cover two superior paths that can still defer taxes while taking a ton of risk and a lot of hassle off the table. But first, when does a 1031 exchange work against you? I'm Brad Johnson with Evergreen Capital. We work with wealthy families looking to compound after-tax capital. And after speaking with various real estate investors nearly every week for the past 12 years, this has become abundantly clear to me. Forcing 1031 exchanges leads to far more harm than good. And this is especially true when investors look to take their foot off the gas. They're getting a little bit older and they're losing their edge on acquisitions and perhaps their willingness to do proper due diligence. And that's just not there anymore. So they cut corners to hit these deadlines that 1031s impose, and they end up making mistakes. And so the problem is they're doing this at exactly the wrong time, when the stakes and the dollars involved are often the highest. Furthermore, a normal 1031 exchange usually forces you to stay active in the deal, and it just ends up transferring risk to a larger property. You're not getting any diversification. And so some investors get trapped in the cycle of doing bigger and bigger and bigger deals while taking no chips off the table in that process. Now, the after-tax compounding can be great if you keep doing good deals. But what if your streak stops? How do you get off that merry-go-round? At some point, you need to stop doubling down on single properties, which are extremely vulnerable to negative surprises, like extreme weather or perhaps regulatory changes that we talked about. For example, even Michigan today is considering rent control. I wouldn't have thought that was possible 10 years ago. So unless you own a large portfolio, simply recycling your capital into larger one-off deals usually isn't strengthening your portfolio. The value is increasing, sure, but so is the concentration risk. All right, so what are your other options? Option 1, a Delaware Statutory Trust, aka a DST. I know what you're thinking. A DST? That's your great option, Brad? Now, just wait a minute. Hear me out. Yes, DSTs don't have the best reputation. The industry was a hot mess filled with a lot of hucksters that were far better at marketing than real estate. But that's not really the case anymore. The market has matured. The top DST sponsors are institutional, publicly traded, and have audited financials and are quite disciplined. There are still bozos out there, so you got to beware, but it's gotten a lot better. There are several $100 billion plus managers in this space now. And these aren't just one-off deals. These are massive portfolios of institutional quality real estate. And it's not the managers' leftover properties that their major investors didn't want and passed on. They're offering the same deals to investors writing $50 million checks as those with $1 million exchanges. Therefore, for someone winding down a diversified portfolio, a DST is usually the cleanest way to stay invested, stay passive, defer taxes, and collect those monthly checks we all love. All right, option 2. The other path is the lazy 1031. Now, what in the world is that? Well, it's a bit confusing as it's actually not a 1031 exchange at all. But that's what the industry calls this strategy. You skip the 1031 exchange in a lazy 1031. You skip it, you take the gain, and then you invest that capital into a new real estate deal, ideally a sizable portfolio, and then you get a healthy chunk of bonus depreciation with that new investment. Now that 100% bonus depreciation is back via the recent tax bill, this strategy is viable once again. It didn't work for the last few years when that bonus depreciation kept being reduced every year, but now it's back. And so this works especially well with assets that have a lot of accelerated depreciation opportunities like self-storage, industrial buildings, aka warehouses, or even manufactured housing communities where most of the improvements are land, which you can bonus depreciate. And these paper losses from the new investments, aka the lazy 1031, this enables you to offset a lot of the taxes from your sale. You get to stay liquid and you avoid the stressful 45 and 180-day deadlines inherent in doing a 1031. It gives you time and optionality. It also can give you diversification if you want to take some risk off the table. You go from one deal to perhaps a portfolio of deals because you're not the one running those properties. All right, bottom line, you get to mitigate a lot of your capital gains, but without all the 1031 exchange hoop jumping. So if you're nearing the end of your real estate run, the traditional 1031 is usually your worst option. Whereas DSTs and bonus depreciation, once again the lazy 1031, they're going to let you defer taxes without being forced into another round of active management. These strategies are best suited for real estate investors looking to simplify and de-risk their portfolio. If you have a $500,000 plus exchange and you want to explore either of these options further, go ahead and apply to speak with our team via the link below. Thanks for watching.